committee. And the purpose of today's meeting is to approve the minutes from the October 1st meeting and also to review and approve the version 11 rules that have been previously discussed. So first of all, the minutes have been provided to all of the members of the committee. And is there a motion to approve those minutes? This is a little problematic because the only attendees at that meeting, there were just a few of us.
Well, I'll move the motion.
Okay, and can I second it?
Yep.
All right. So there's a motion and a second to approve the minutes. All those in favor say aye.
All right.
Aye.
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 All those opposed? Say nay. Well, there's none opposed, so the motion is carried. So the minutes are approved as drafted. Then there are 6 new rules that we would like to go through at today's meeting. But first, maybe, Campbell, would you like to review the bug fixes that we've made in the previous rules?
Yeah, and I think did we send out the details of those?
Well, they're just in the agenda. They're just mentioned in a highlighted way. I don't think we have the details of them.
Right, so there's something I think we do there. We have the DQC 15 negative values just on David's screen. So that the first bug fix there was to remove there was an interest rate. We have an element for the Federal Home Loan Bank advance interest rate that can't be negative. However, one of the Federal Home Loan Banks contacted us a week or so ago and said, oh, actually, we have negative interest rates now, so they can be negative. So believe it or not, in the United States, we have negative interest rates now. You heard it here first. So we changed the rule so that for this Federal Home Loan Bank interest rates now allows negative values. So the other items for then there were negative values for some of these IFRS filings, and so we updated these, and these are really kind of like the share-based compensation type elements. There were 3 there, and you can see them on the screen: expense from share-based payment, expense from cash share-based payments, and expense from equity settled share-based payments. So those elements where we have removed the non-neg on those for the IFRS, because in some cases there can be reversals of that share-based comp, which could mean they could go negative. And then the 4th one there was the risk exposure associated with instruments. So this is basically a risk exposure element. David, I can see your email. So that was some of the bug fixes. The other bug fix for DQC1, we noticed this the other day, was we were giving inappropriate errors for the product or service axes, and specifically in this case it was for, I've listed these here, the regional carrier member and the mainline member. Airlines were using those, and then we were saying these were incorrect. The reason for that was we basically read the US GAAP taxonomy, but Lewis, I've got to talk to you about this. And we read the dimensional structure of the taxonomy, and these items here haven't been included in the table structure in the US GAAP taxonomy in 2019 correctly. So what was happening is companies—
Which items are you talking about here?
These are the regional carrier member and the mainline member. If you look at the way that the table is constructed for this particular disclosure, it's the table. It's not a valid table. I'm not sure if it's meant to be or not. We had assumed they would be. So I just got to follow up with you at some point. In the interim, though, we've changed the rule so that if people use if airlines use these members, they're not going to get an error resulting for them. I'm not going to get into it as like a specific detail around how XBRL tables are constructed. So it's kind of a little bit complicated. So it's like a half-hour conversation.
All right. Good. Just send me an email so we don't forget about it.
Yeah. And I don't think it makes any difference. It's just really for people who are building, they're going to build their own tables anyway, so they get around it. So that was really the updates to the version 10 rules that we have done. There was other bug fix. It's not on this list, but there was just because it's not really for approval. There was a typo on one of the elements, so we corrected that as well. And that was on the cash flow for elements related to construction costs for moving between financing and investing. So the rule just wasn't operating correctly because we had space at the end of it, so we fixed that as well. So that's kind of where we are on terms of the bug fixes for version 10.
And those are already incorporated on the realm,
Yeah.
is that correct?
Yeah, so there's a release called version 10.03, so those have been incorporated into that release.
Okay, so I don't think we need any further discussion on that unless there's any questions. So then let's just go right into the version 11 rules. And Campbell, can you walk us through each of those?
Sure. So Dave, may you want to click on this first one, axes within appropriate members.
Campbell, for this one, I think it's just an update to the existing rule.
That's correct. That's
I
right.
don't know that there was a document associated with it, so I'm just linking to.
Yeah. So for this rule, this is basically in some cases what this is doing is basically saying, look, if you've got the business acquisition axes, you should have an extension member on this. So this rule is basically testing if each of these things are extended. So we would expect from business acquisition, you'd have a custom member on it. So it's checking that you have a custom member on this axis. So basically, this is a pretty straightforward rule and is pretty similar to the rules that we have for DQC1.
Well, there are standard members that can be on it, but it's checking it's allowing an extension member on it. Isn't that correct? Because there are standard elements for like a grouping of business acquisitions.
Yeah, so let me give you the exact details on it. So, let's bring it up. One second. Thought I had it here, but I don't. Yeah, so what it does is it looks at the business acquisition axes that's used in the taxonomy, and it looks at the members that are allowed that can be used. So it looks at those and it says, okay, you're allowed to use these on the business acquisition axes, whatever's defined in the taxonomy. And then it then goes and then compares what the filer actually filed, and it makes sure that they haven't used any members on there which they haven't gone and taken another member from the US GAAP taxonomy and put it on that business acquisition axis. So it's basically making sure that when you have that business acquisition axis and you've used it, you've only used extension members or members that are allowed on the business acquisition axis. So that's what it does. Because what we found was when we were looking at this, people were putting like product members and other kind of stuff on here. So that was kind of one of the issues with this. It's not that, I think when we looked at about 2,000 filings, it's not going to be a big impact, but we saw about 20 problems with this particular one. So we just want to, since we had it, and people have been asking us about doing analysis of acquisitions and we're looking at this data, it was just being an annoyance for them when people were using the business acquisition axes when they probably shouldn't have been. Does anyone have any questions on this one? Okay, so the next rule is DQC 80. This was updates to the negative values for the IFRS filings. So we have a list of what all these are, but there are, there's what's the total there, David? can't remember off the top of my head,
I
100
think
odd
it's 60
elements, 67 or
62.
something. Yeah, 62 elements that were of the elements that were added to the IFRS taxonomy in 2019. We just made sure that we basically recorded the negative item, the items that we thought should not be negative. So that's being added for this release as well. We don't really have any, we didn't do an impact analysis on this just because the amount of filings coming in is not that great at this point. But as we go through the year end, we should see any issues. So since it'll be in public review, if there's any changes we need to make, we can make them before we release. Okay. Any questions on this one? This one's pretty straightforward. Okay, next one. DQC, what do we need to hit next? 85, deferred tax assets and liabilities. All right, this rule's a little bit, there's a number of rules here, but basically what this rule, we talked about this last time, is trying to address is where companies have taken the deferred tax elements, and there's a bunch of them. There's ones that can be in the notes, and there's ones that can be on the face of the financials. The ones at the notes don't allow multilateral netting, and the ones on the face do. So you don't want to use the note elements on the face and vice versa. So we have a bunch of rules for this. So we started running these the other day. We took a sample of 1,000, and I think for the first one, we're still running them, but roughly, I think we've got like 55 errors so far, and we've gone like halfway through, like through 1,000 of these filings. So, and the types of errors on these are basically they're in 9361, which is the first, if you want to, is the first one. So basically we've seen about 55 errors for this come up so far. And most of them are they've just used the wrong element, and they've put it in the face financials when it should be a footnote disclosure. So just so you know, we're going to be going through in the meeting today at 4 o'clock, and we're just going to go through the impact analysis, and the Tuesday group is just going to make sure that they're all okay with it, and then there's nothing buggy with it. So if we approve these rules to public review, one of the things just to make sure we'll just make that it's going to be subject to the Tuesday group, the call at 4 o'clock, just making sure that there's, looking at the specific details of these rules and making sure that there's no issues. So that's one thing we'll be doing this afternoon. So that's 96.1. So basically this is tax footnote elements being used on the face of financials. 9362, this is basically saying I've got a, they've reported a value for something which would be an income, which would be a balance sheet item, but they don't have a calculation defined for it because they've reported a value for it, but it's not appearing in the balance sheet or a component of the balance sheet. So basically this rule's just flagging those. And we have how many of those do we have? We have like 40 odd that have come up for the filings we've run. So the impact's not that great, but it kind of does screw things up when people get this wrong if they're looking at taxes. 9363, this element is then basically looking at the it's kind of similar, but it's the other side. It's the deferred income tax liabilities net. And it's just basically looking at it, saying it also doesn't appear in a calculation. It's a balance sheet item, and it should appear on the balance sheet as a component of the balance sheet in the footnotes. And basically it's saying if you've, it's really looking for items that you're meant to be tagging it with the footnote item, but you've gone and tagged it with the balance sheet item, and you've tagged this value, but it's not appearing on the balance sheet. So what's going on? In 9364, this element, it basically looks at the calculation link base, and it says, is the item a child of assets? And if it is, then it flags an error because it's looking at the footnote elements, and it's just making sure they're not calculating up into the balance sheet. So it's kind of similar to 9361, but it's basically looking at the calculations to do it. And then in 9365, there, David. same thing, but it's a descendant, and it's just looking for these footnote items, and it's just making sure that they're not being included in totals which roll up into the balance sheet. Then finally, 9367. It's kind of a similar rule, but it's looking at the deferred tax liabilities and making sure they're not rolling up into liabilities or liabilities in stockholders' equity. So all of these rules are really just trying to sort out these deferred, making sure that these deferred tax asset and deferred tax liability elements are being used in the right place and that they're rolling up into the balance sheet. One of the issues that the only thing on this that we kind of probably need to discuss on the call later today is, in some cases, they will report amounts in the notes and they will say, oh, this deferred tax balance is included in other liabilities or other non-current assets. And at the moment, a lot of times they're not putting that in the calculation. And I think one of the things we want to do is we would expect them to still add it into the calculation because they're specifically saying it's included in other current assets or other non-current liabilities. So I think we want to include that calc, even though it's not appearing on the balance sheet, but that would just be explicit, and then would make sure that the filing is actually consistent. The XBRL filing is consistent with what they've got in the paper filing, and just reporting the information of, where is this deferred tax asset going, into which account on the balance sheet is it going, if they haven't explicitly reported as a separate line item. So the rule is actually picking those cases up. Any questions on deferred tax assets and deferred tax liabilities?
So all of these elements that we've just been discussing have a taxonomy implementation note included in the taxonomy that describes basically everything that these rules talk about. So this is really just confirming that people have applied the taxonomy implementation guidance.
That's right. All right. So I think probably best to go through all of them and we'll just approve them as one lot, or do we want to just approve them to move forward by public review one by one?
It would be
My
better,
preference.
yeah, to go through all of them.
All right. Okay, the next rule, DQC 86. This actually does have quite a high impact, and this is tax transition elements. The FASB identified a bunch of these elements in the taxonomy, and what this rule does is saying, look, you shouldn't be using any of these elements anymore. Everyone should have switched to the new accounting standard at this point. This rule only applies to filings using the 2019 and 2018 taxonomy, and basically it's as simple as this is a transition element. Everyone should transition to the new standard. If you're using this element, then you should switch it. So at the moment, I think we ran this, we've got about 3,213 individual facts. In some companies, obviously, that some companies may have 4 or 5 of these errors or more if they've used all those elements. So, but based on an individual fact level, we have like about 3,500 errors for this. So this rule should actually do quite a bit of, should be very helpful in terms of making sure everyone's using the new tax elements. And at some point in the future, these are going to be deprecated anyway, but today they're just using the wrong elements for them. So we kind of want to get this, make them aware of it and get it cleaned up. Any questions on this one? Right. So I think that one's pretty straightforward. Next one, 87. All right. So this rule, okay, so now all the rules 87, 88, 89, 90, the next 4 rules really apply to leases. So we want to get these rules in. We don't think they're really going to be effective until the next version of the 2020 taxonomy comes out, but because that's kind of when people have to start complying with the operating lease everyone should be complying with it. But we want to be able to have these rules out now so people can at least make sure they're aware of what they are and they can correct their filings. So Rule 87 is basically saying you've reported an operating lease liability, but you haven't included in the financial statements of the filing. And basically saying, look, if you've reported an operating lease liability, the operating lease is a total or the current or the non-current portion, then you should be including it on the face financials. And if you haven't included in the face financials, there's an extensible list item you should be using, which basically tells you which account that's been included in. If you haven't used that, you can use the balance sheet location axes if you've disaggregated it. So, and if you've not done either of that, then this rule is going to flag an error. We're going to make a slight tweak to this for the public reviewers, just to say, look, it's got to be that operating lease liability has got to be in the default as well, which means that some cases we're seeing people, they're reporting an operating lease liability account, but they're saying, oh, this is what we estimate our operating lease liability to be. So we're going to tweak the rule a little bit to make sure we exclude those. So then, because those obviously shouldn't be included in the financial statement, or not in the balance sheet at least. So that's kind of what this rule is doing. At the moment, from what we've run, we haven't seen any errors for this in our impact analysis. And the main reason for that, because this rule will only run on a 10K or a 10KT, basically a year-end filing. But this rule is just really to make sure that we don't, when people do start filing, we're not going to have this as an issue. Any questions on this? Joan, do you have anything to add to this?
No.
Okay. So the next rule, DQC 88. Okay, so this rule is looking for the company's reported operating lease expense, but they haven't reported the operating lease cost. So you're required, if you report the operating lease expense, then you should be also reporting the operating lease cost. This rule only applies to 10Ks and 20Fs as well. So at the moment, we're running on remember that very few filings have been made at this point, which are 10Ks, which have the whole lease standard adopted. So we haven't identified, we're still running at the moment. We're trying to find some cases where companies got errors for this. We haven't found any yet. But this is really following the guidance that's been issued by the FASB. So we just want to make sure that we've got the stuff in the FASB guide covered. But we'll put it out for public review and let's see if anyone's got any comments on it. Okay, next rule is Rule 89. This is the operating lease weighted average remaining lease term. The FASB had identified this as an issue where people were using this element with the range axes, with a minimum or a maximum. But since it's a weighted average, we don't expect that to happen. So this rule basically flags where the operating lease weighted average remaining lease term or the finance lease weighted average remaining lease term has the range axes on it. And if you use the range axes, it basically tells you should use create an extension element called either for operating lease remaining lease term or finance lease remaining lease term. And I believe the FASB is going to actually add these elements in the 2020 version of the taxonomy. Is that right, Lewis? He may not.
Sorry, I was on mute, but
thousands of these.
I would need Donna or someone to respond to that.
Yeah, we talked about it in the past. So once those elements are added to the taxonomy, we'll go back and we'll update the rule just to refer to those explicit elements. So at the moment, if they were to file today before the 2020 is released, they'd have to create those extensions.
So these for 2015-17 tax items, we will not remove until 2021. Emerging growth companies may need interim period in 2020, may need for interim periods in 2020.
Okay.
What does that got to do with leases? Or did I miss
don't know.
something?
Where are you reading?
I'm reading
That's going back. to Rule 86.
So yes, we are adding the lease terms.
Okay, yeah, okay.
Yep, okay.
All right. And then finally, Rule 90. All right. So, all right, this is interesting. So this rule also will only run on a 10K. So in the lease disclosure, you're supposed to report these are all our future payments, payment, going out to the next 1 year, 2 year, 3 year, 4 year, right out to forever. And then there's a reconciliation between the total of all those future lease payments and the total value of the liability that you have on your books. And this is done for both the finance leases and the operating leases. And the difference is what they call the undiscounted excess amount, which is basically the difference between the future payments and it's basically the portion that represents the discount on those payments and the value that you'd use to calculate the operating lease liability. So companies required to do this reconciliation. So we've put this rule and we noticed the FASB noticed some problems with this, with people using the wrong element. So we put this rule in basically to check this calculation. And we did an impact analysis on, we looked at a bunch of filings, and only to date, I think we only found like 10 companies that had reported it. However, 2 didn't balance. And the reason for that was that they had put in additional line items in the reconciliation. So they had included, somewhat dubiously, things that took their operating lease liabilities right down. So, for example, some people would put payments in that, additional payments they'd made to the leasee, but were expecting a refund and they had deducted them. And so, I think, we'll discuss this on the Tuesday call. I think what we want to do with this. So for this role, I think we should approve it, but just subject to approval from the meeting that we have today. And we can go through and people can call, make the call if they think some of this stuff's appropriate or not. I personally don't think it is, but so this rule here is maybe subject to change.
So what's the issue in this one, Campbell? I'm not quite clear on that.
So you have this reconciliation, right? So the rule says, okay, does the operating lease liability equal the sum of all the future payments less the excess discount amount?
Right.
In some cases, companies have put extra amounts in that reconciliation. So specifically, one example was a company basically said, oh, we've got an operating lease and, we expect, we've rented this building for the next 20 years and our operating lease liability for this is whatever it was, $80 million, right? However, we went in and then we did a whole bunch of renovations on this building. And then the person who we're leasing the building off, or the entity we're leasing the building off, is going to repay us for the amount. So rather than going, credit cash, debit accounts receivable, they went credit cash, debit operating lease liability. So the operating lease liability was much lower at the year end. However, when they get that repayment back, the operating lease liability is going to jump up again by the 30 million or whatever it was they spent. So what they've done is they've artificially deflated what their actual operating lease liability is by saying, oh, the person, basically they've got a receivable from the leasee and they've offset that against their operating lease liability. But you would expect that you wouldn't be netting those. You'd expect that I've got a receivable on the balance sheet from the leasee, and then I've got my operating lease liability, because now you're polluting your operating lease liability number, right? So you're not really getting a true reflection of what your operating lease liability is. That's what companies are doing. Now, should they be doing that? I don't know.
But is that a tagging error?
Well, I would argue that you shouldn't be using the operating lease liability tag in that case. It's really operating lease liability net any receivables from the lessee.
Is there a separate tag for that?
No.
No. So, I mean, so the problem is that, it's the conflict between, are you trying to limit the number of extensions in your file, or are you trying to be super precise? And so
I think it's important, and there's a lot of people here who do analysis on the call. If you went and got the operating lease liability, you would not expect it to be netted against that. Right, Pranav? If you're asking for operating lease liability, you wouldn't be expecting them to net it with any amounts owed from the lessee, right?
It's unusual. I've never seen that.
But it's being done, is what you're saying.
In some
Well,
limited
we
in
got
some
one
limited
example.
cases, yeah.
Yeah.
Well, I think there's 2 examples of it. And maybe, Lewis, you can go back to the FASB and you could ask them and say, hey, is it okay for people to be netting these?
Well, that's a gap question, right?
Right.
Right.
So here's the question. Should the operating lease liability element, should that be just your gross operating lease liability, or can you net amounts due from the lessee against that?
We were just discussing this amongst the team last week, as I recall, and not that we had an answer, but it struck us that there might be some cases where the netting was acceptable, not from a true gap perspective, but because.
See, here's the thing. Like on this, I think just from an analysis perspective, it's really bad to do that, because I've got the operating lease liability. It's an asset.
Yeah.
I'm counting it as a financing type operation, right?
Yeah.
So it's
So Campbell, actually, we did. Donna's reminding me here. We had written up a memo as a part of our leasing review, and one of the items we identified for the board was this offset and whether it was appropriate or not. So we have posed the question.
Yeah.
We don't have an answer at the moment. We have actually posed it to the technical staff and the board.
So netting against the lease income or lease asset?
the lease liability
No, lease liability netted against what?
against a receivable from the lessee.
sublease.
Yeah, sublease income, right?
Well,
Right.
no, in this case,
Also,
in
it's for
one
lessor.
case, yeah. So I lease you a building, right?
Right.
And then you'll put on your balance sheet an asset, and let's say it's an $80 million lease discount rate. So you'll put an asset for 80 million and a liability for 80 million.
Right.
And then in this case, what happened was they said, "Oh, we're going to go and do some work on the building, and put some cubicles in or whatever, right?" And then they went back to me. The lessee said, "Oh, we're doing this work and we're adding value to your building." And the lessee said, "Oh, okay, I'll repay you for it. I'll pay. Can you just do the work for me, and then I'll repay you the amount that I owe you." But the between doing the work and spending the money and the repayment spanned a balance date, right? So what they did, rather than saying, credit cash, debit accounts receivable, which you'd think they'd do because I got accounts receivable from the lessee, they did debit lease liability. So what happens is when I make the payment back to the company, then they'd go debit cash, and then they'd go credit lease liability. So the lease liability would jump after the year end. But at the year end, the lease liability would be netted against this accounts receivable. Now, if I had paid early, if I had paid before the year end, then the lease liability would have been much higher. So basically, if you can do that, you can manipulate what your lease liability is around year end, because it's not really a true reflection of what your lease liability is. It's like they're offsetting. If I gave a loan to the lessee, you wouldn't expect them to basically net the lease liability for that amount. Because now, especially from an analysis perspective, let's say I want to work out what's my return on my, if I'm looking at the return on my assets, or I'm looking at what's the true cost of ownership of these assets, then you kind of you don't want to be netting them. Maybe no one cares, and if that's fine, then maybe we need to change this rule so it works differently. But at the moment, the rule's saying no, you shouldn't be. Basically, the impact of the rule is the way it's written at the moment is saying you shouldn't be netting. You shouldn't be netting these amounts against your lease liability. And it's not clear. It's not clear. And the only reason this is coming out is because we were trying to write this rule to make sure that that this reconciliation was being done properly. Specifically, we were trying to pick up where they'd used the wrong elements in the reconciliation. But the only reason this rule's not working is because of this reclassification. So there's additional items in this reconciliation that we weren't expecting. In all cases, in both cases we looked at, it always made the lease liability smaller.
So it's possible we'll tweak this rule as we do further review with the participants of the afternoon call.
Right.
And we're expecting it'll be in here in some form unless there's any further comment from the group. So should we go to the next rule, Campbell?
I think it's it. Am I missed one?
Oh, yeah, that's it. Okay, so what we're looking for is a motion to approve this version set so that we could post it for public review on the 15th. And that would be subject to any suggestions or modifications that are made when the detail group reviews the impact analysis on this afternoon's call. So at this point, there would be, what we want to do is be able to get these rules posted so that we can then get a broader audience to provide feedback on it. I think the public review period, Amy, would be 60 days.
45. So
45.
the plan would be, November 15th through the end of the year for the public review.
Okay. So is there a motion to approve these for public review? It is the silence, does that mean that the group disagrees with approving these for public review?
Pranav, are you gonna vote on that?
I would vote to approve. I was looking through the lease liability issue for outliers. Sorry, while we were talking, because
Okay.
so a motion. Do I second the motion?
Oh, we
You
want
move
you
the
to
motion.
make the motion.
I'm gonna make the motion.
Oh, okay. I'll make the motion to approve. Sorry.
Well,
Someone else go off mute, please. Everybody's on mute.
Mohini,
We're so polite here.
I'll second it.
Okay, so we have a motion and a second to approve version 11 rules for public review, subject to the final sign-off of the afternoon group after they review the impact analysis. All in favor say aye.
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 All opposed say nay. Okay, so I think the motion carries, and we will post these for public review on the 15th for 45 days. So the committee will get a second chance to then review them before they actually get put in place after that review period expires and before they become effective.
At the next meeting, we'll pick what the effective date of the rule will be, so we can make sure that it's okay. Just so everyone knows, obviously now that we're publishing the results of these rules, a lot more people are looking at them, and so we're getting a lot more feedback, which is great. So one of the things we're trying to do, obviously, is if there's a mistake in one of the rules, we want to try and correct that as soon as possible. So, and we want to make sure that we've got adequate time for people to review them and get their comments in. If we make the effective date later, then it's not going to show up on any lists. But once we agree on an effective date, and once we go past that effective date, then we'll start reporting out the results of those. David's brought it up. Yeah. So that it's good in a lot of ways, because if there's a mistake, people tell us about it, and so then we can get those errors corrected. And we try to be very responsive to that as well. And then if there is an error, just so you know, we will go back and rerun the rules with the updated rule set, so that those companies not going to be showing errors where they don't really have a legitimate error.
Joan and Campbell, it's Michelle Savage here. Do we want to issue a press release on the public review?
Yeah.
Okay, and probably do a webinar and on rule set 10 and on the public review?
Yeah, rule set 11. Yeah.
Well, just finalizing 10.
Yeah, 10's finalized.
So Campbell, to what extent do these changes to rules 1 and 15, I guess, impact what we're doing with the US GAAP rules taxonomy?
Yeah, I've sent those to David, so he's updated it for those.
But these aren't really final until the end of December, right? Based on public feedback?
No, not the non-neg ones. The non-neg ones we've pulled out because we know they're wrong. Like the negative interest rate one, we know, we put that in not expecting interest rates to be negative in the US when we put the rule in, and then now we have cases where they are. So that rule has just been removed. And we knew about this, so I'd let
10
David
is already effective, right?
Yeah, exactly.
Or these rules are.
So the only one that would affect you is that one for DQC 15.
So on
DQC
DQC1, we've got the fix the bug that excludes the regional carrier members, the mainline member, and the.
And you already have that in yours.
So we
you already-
have that.
Yeah, you have.
Okay.
Yeah, you have that, and then DQC 15. I report that to David, so you have that, and he's
Okay.
got it updated for it. And then DQC 1, even that rule exists. That one is still going into be. Sorry, there is a DQC 1 for public review. That will not be in your rule set though, because that's going to be that's still only in public review.
Which one is that? Is that the business acquisition?
Right.
tax?
Yeah. But it has another sub number, right? So, the expectation is that you've got to run those. Every rule has a sub number. So obviously, that's still in public review. That's not going to be in your list, which shouldn't be.
All right.
Is there any other business? Future meetings have not been set yet, right, Amy?
Yes, they have, and invitations have gone out. So the phone meetings have been set. The next meeting is February 12th. Eastern time. That will be a conference call. After that, we have the July meeting set. But I'm going to work with SEC for our spring meeting, for our in-person meeting date. That's open at this point.
All right.
All right, if there's no further business, we can adjourn the meeting. May I have a motion to adjourn?
I motion to adjourn.
Is there a second?
Second.
All in favor, say aye. Aye.
Aye.
Okay, the meeting is adjourned. Thank you all for your attention.
Thanks.
Bye.